Hi everyone, Ankush this side. Thank you so very much for joining in. Today we will be covering a brief introduction on the gratuity fund management. Uh, while all of us would have heard about gratuity as a word as an employee, everybody would know that the gratuity is payable after 5 years of continuous years of completion with a single organization. Right. I'll be covering a brief about gratuity fund management. This is more from a organization perspective rather than from an employee perspective. In case if there are any questions around it, I will be more than happy to answer all the questions towards the end of the presentation. So in this presentation, we'll be briefly covering that what is gratuity, how does it work, what is the benefit which you will have from a SecureNow perspective, and also we'll be covering just give me one second. So what is the process to outsource the gratuity? So coming on to the basics of gratuity, I'm sure everybody would be aware that the gratuity is payable after completion of 5 years of continuous service. The formula remains 15 by 26 into the last drawn basic salary into the number of years of completed years of service. So why 15? So this is a very commonly question asked by people that why is it 15? So it is basically the half month salary. And 26 is excluding 4 Sundays. So when we minus 4 Sundays from 30, so it makes it 26. So 15 by 26 into last drawn basic salary into number of completed years of service. This is payable in case of a resignation or a retirement, subject to person completing 5 years of service. Whereas this 5 years is not applicable in couple of cases. One is a death of an employee during the service. Prior to completion of 5 years. Second is the person going permanently disabled, whereby the person is not able to kind of perform the duties due to the disability. So here I would be covering 3 things, how the gratuity as a, amount is managed in the books of accounts. The very first way is a pay-as-you-go. This is a very commonly used method of using the gratuity, which is commonly known as provisions in the book of accounts. So which basically means what? That while you will assess your gratuity liability via actuarial certificate as on 31st March every year, you will make provisions in your books of accounts. However, the money is not parked aside, which basically means what? That this money is actually being used in your business and through the business, the profits are being generated, but this money is not kept aside. Second one is, whereby you decide to outsource this gratuity liability to an insurer. So insurer, acts as a fund manager for you, whereby the money is invested to them by creating a trust. Now, what is the benefit of creating a trust? So the 2 benefits which primarily come into picture is what? First, the moment the trust is created and once this money has gone out into the trust account and eventually to the insurer, this money can never ever come back to company's bank account. So which basically means that you are safeguarding this gratuity money for in case of the payouts to be given to the employee. Second major benefit is that once you outsource this gratuity liability to a fund manager, which is the insurer would be generating the returns which will offset your future liabilities. So I'm just taking an example for the understanding. Let's say the liability of any company is, let's say, 10 crores, and the company decides to outsource maybe half of it, let's say 5 CR, and there's a 10% return on that. So next year it becomes 5.5 CR. I'm considering that there are no payouts. So 5.5 CR, and next year when the actual valuation is done, so let's say that comes out to 10.5 CR. So the company will be liable to outsource the money only to the tune of 10.5 minus 5.5, which is only 5 CR. The third one is a self-managed trust. It is no different from insurance managed trust. The only difference is in the second case, the money was being managed by the insurer, whereby the investment team of the insurance company is managing the investment portfolio completely. Whereas in the third case, which is self-managed trust, the money will be managed internally. So any organization which thinks that they have the capability of managing the funds on their own, they can probably go in for a self-managed trust. However, there are challenges to it, whereby today you may have somebody who is capable of managing the investments on the gratuity side, but tomorrow if that specific individual leaves the organization, there can be a challenge. Second is that in a self-managed trust, since it is individual who's going to be investing, he may or may not have an expertise on investment, whereas with the insurer, the entire investment team who has multiple years of experience, they kind of manage it for you. Right. So the next one would be, why the amount should be outsourced to an insurance company. So I'll give a very good example of company getting bankrupt. For example, Kingfisher or maybe Jet Airways, who had to shut down their operations, as a result of which the every single employee of these organizations were actually eligible for a gratuity payout, even if they had not completed 5 years of service. So, covering this slide, outsourcing the fund to a fund manager. Why should the gratuity be outsourced? It is primarily, there could be the bulk resignations, bulk deaths, slowdown in the business. So as a result of which, there can be a, huge requirement of the, gratuity to be paid out, which will definitely hit the cash flow of any organization. So it is always advisable that the money is kept aside so that it doesn't hit your cash flow. Tax implication is what I had covered earlier. So I'll quickly cover it again. Whatever amount is outsourced to an insurance company via creating a trust, in a specific financial year, that amount, whatever is given to an insurance company, is treated as an expense in books of accounts, as a result of which the corporate tax benefit is enjoyed by the company. So this is where SecureNow will play a role. As a advisor, as your consultant, what we are going to do is we are going to give you the complete details, and the information of all the insurers. How the funds have performed, what has been the assets under management, what has been the investment philosophy, how do the investment team see the markets behaving in the future. So everything is going to be captured in a single document, and it is going to be shared. However, in case if there is any specific requirement by a client, that can also be arranged. So here what I was covering was that what is the process of gratuity fund management. The very first step is to create a trust. And for creating a trust, the organization will have to pass a board resolution that, as a board, it has been decided to outsource the gratuity to the fund manager. And parallelly, once this board resolution is in place, parallelly, the organization will also have to appoint the trustees within the organization who are going to be managing the day-to-day activities of this trust. Once this is in place, the company will have to formally create a trust. Once the trust is created, the trust is filed with the Commissioner Income Tax local office, and this office will give you the acknowledgement that yes, they have received the document, while the approval will eventually come over a period of time. But as an organization, you're good to go and outsource your gratuity liability to an insurance company. And this slide I was covering that what are the products available in the market. There are two types of product broadly available. One is a traditional and the other one is a unit linked insurance plan, ULIP. As the name suggests, the ULIP plan has a component whereby the amount is being invested in the share market. Amount is being invested in the share market, and as a result of this, the investment done are subject to market risk, as we fondly kind of call it. However, in 16 years of my career, wherever the organizations have chosen to invest in a ULIP plan, I have personally not seen any investment going in negative, because these are long-term investments. And looking at the lower interest rates, traditional plan doesn't fetch you a higher return. So today the returns would be in the range of 6, 7, 8%, whereas a ULIP plan can fetch you as high as 11, 12, 13% also. So also the ULIP plan comes up with a fund option whereby the government securities. The government securities are also into place. So commonly used fund option is a 80-20 plan, whereby 80% goes into the debt instruments and 20% of the portion goes into the market. So this is one of the very commonly plan used by the corporates. While traditional plan, as I said earlier, it carries a capital guarantee, which means that whatever amount has been given today to an insurance company, no matter whatever happens to the investment, your money given is safe. Yeah, I'm kind of good to go. Any questions, I'll be more than happy to answer. In case if you want to ask any questions, would request you to put it in the chat box, or in case if you want to ask it by unmuting yourself, please go ahead. So I'm done with the basics of the fund management. Any questions, I'll be more than happy to answer. And in case if there are any deep dive discussions which any of the corporate would want to have, we'll be more than happy to come in personally and catch up.
Hello everyone. I encourage you to ask as many questions as possible, even if they are very basics. So Ankush can help you get answers to those.
We'll maybe wait for one minute for people to ask questions. Rajesh sir, I don't know whether you've joined or not. In case if you're there, I'll be more than happy to answer your questions. Sunil, do we have any?
Ankush, I just pinged one question on your screen. Chat window.
Can you just see it? I can't.
So I'll read it out. What is the
Please.
latest on gratuity policy 2022?
I didn't get that question. If some,
Some latest update that has happened to the new gratuity policy 2022.
see, there's nothing latest per se as far as gratuity is concerned. The only thing latest which is coming up is the wage code. So once the wage code comes into picture, the liability is going to go multifold, and that is one of the major reason that the gratuity should be outsourced. And very commonly question asked is that whether the gratuity should be outsourced. When should the gratuity be outsourced? So, if you ask me personally, even if your organization is as small as maybe 10, 15 employees, we should actually start the gratuity policy as soon as, the company comes into picture. As far as, anything specific changes in gratuity, there is none. The last change which came was, sometime back, whereby the gratuity liability was increased from 10 lakhs to 20 lakhs, non-taxable ceiling. Any more questions? As basic as, why should the gratuity be paid? When is the gratuity being paid? Okay, so I have a question which has flown in, which says that, can a company outsource their gratuity liability to multiple insurers? Yes, it can go to multiple insurers. Also, it can go to the same insurer with two different products. So let's say as an organization, if you choose to put in, let's say 50% in traditional and the 50% in ULIP, yes, that is very much possible. And if you want to choose to, give it to the multiple insurers, as many insurers as you want. Okay. Can this 5 years be, reduced to 3 years, 2 years? Yes, it can. It is an organization who decides to, reduce the eligibility criteria. So as per the Gratuity Act 1972, it says that you have to stay in service in continuation for 5 years. To be precise, it is 4 years and 240 days. So if you have served an organization for 4 years and 240 days, you are eligible for getting the gratuity. However, in case if the organization decides to reduce it to 4 years, 3 years, 2 years, 1 year, or even day one, yes, it is doable. And in case if the organization wants to pay the gratuity uncapped, which is the upper ceiling of 20 lakhs, yes, it is payable. However, the amount paid over and above 20 lakhs will be taxable in the hands of the employee. So the whatever is the difference that gets added to your income, and that is taxable. Okay. Can this money go back to the organization? No. Once that trust is created, if you remember, I had used the word that the trust is irrevocable. So once the money has gone out to the trust bank account and eventually to the insurer, it will flow back to the trust bank account, and from the trust bank account, it will directly go to the employee. The money can never ever flow into the corporate bank account. Sunil, any more questions?
I think I've pinged audience multiple times, but I think they don't have any question as of now. But we have shared the support alias email ID, and we have also shared the contact number for SecureNow. So you're most welcome to raise any queries one-to-one. We would be really happy to answer those promptly.
Sure. Thank you so very much, everyone, for joining in. Sorry, there was a little bit of a technical glitch and a sound at the background.